Hello, everybody. Welcome to this webinar brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia. And this webinar is also managed by Wellford. And today, our webinar title is Technology Sector Outlook, Is the Worst Over? Now, before we begin, as usual, disclaimer, whatever we share with you is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any listed securities that you mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now today, we are going to look into the technology sector. What is the outlook like? Now, as you know, the technology sector has been in a prolonged downtrend. So the key questions that investors have in their mind is the worst over? Have we hit the rock bottom? Will we benefit from the growing adoption of artificial intelligence? So today, we're going to explore this topic. Joining us in this session is a head of technology and tactical strategy from Kenanga Research, Mr. Samuel Tan. So we are very honored to have you here, Samuel.
Yeah, thanks, Sean.
All right, how are you today?
Good. Thank you so much to Sean and the team for arranging this session, and thanks for everyone that has dialed in to take time off your evening.
Yeah. All right, cool. So let me just stop sharing and I'll hand over the slide control to you.
All right. Okay, let me know if you're able to see my screen.
Yes, perfect. You may go
All
ahead.
right. So thanks, Sean, again, and thanks everyone that has dialed in. Thank you for taking time off your evening on a weekday to join this session. Hope we can learn a thing or two as to what is the outlook of the tech sector, or specifically the semiconductor sector, where Malaysian players are more concentrated in, which is a hardware semiconductor. So just to give you a glimpse of what has happened in the tech sector and what is the current state of things. Since the COVID happened in end 2019 and we had our first lockdown in the early of 2020, we saw a big dip. This is, by the way, this is the KL Tech Index, which tracks most of the technology counters in Bursa, Malaysia. And we saw a strong 20-month rally, which ended in November of 2021, followed by a 12 months decline. And now we are here, which is a sideways pattern for the last 12 months. I'm not going to go deep into technical charting, but this is just a bit of a overview on how long have we rallied, how long have we declined, and where are we now as of today. But I will share more on what are the fundamental aspects that has caused such movement, and what are the other key points that we can look forward to in order to have a better idea of the outlook of this tech sector. So overall, on a house view basis, the research team is still having a neutral recommendation on the sector. And we see that the sector is still very much still reluctant to show any strong rebound, or alternatively, it's not weakening as much as, say, the previous chunk of 12 months that we saw the decline. And we are typically being trading sideways for the past 12 months, or the past 2020, the whole 2023, with no strong indication on where the direction is. But overall, we are seeing the year of 23, calendar year, is likely to be a write-off, where we can't really expect very strong momentum, whether upside or downside, for the tech sector, as there's weak order replenishment. So these tech guys are not seeing the order replenishment that they used to see during this period, the first 20 months. And this is simply because a lot of economic factor that is also affecting their customers, as much as a consumer, your inflation rate, your interest rate, so much and so forth, that is affecting the optimism of their customers or their commitment to place orders. As such, we see that if you look at the chart on the right, you can clearly see that the smartphone sales, which Malaysia is quite involved in, has shown a lot of consecutive declines for many quarters. Worldwide PC sales is also on a downtrend from a high in 2021. And even for global semiconductor, which expands beyond smartphones and PC, they are still sitting at a year-on-year decline of 17.3%. However, there's month-on-month improvements, but we believe that month-on-month is not that strong of an indicator to actually call for a blanket change in our recommendation. So on April, month-on-month, you see 0.3% improvement. May, you saw 1.7. June, you saw 1.7 against the previous month. Quarter-on-quarter, there's a bit upside, 4.7%, but year-on-year, which is a better comparison, is still down quite a bit at 17%. And for this year, if you track what the World Semiconductor Trade Statistics has been providing, which is basically a body that has all the semiconductor participants under it, be it from US, from the EU, from even China, the whole world semiconductor players contributes to these statistics, and they are looking at a 10% decline for 2023. And one of the factors that is affecting that is the elevated interest rate, as well as high inflation rates, has actually deterred a lot of consumer spending. So consumer now actually, you and me think twice on gadget purchases. I believe you and me have actually purchased the upgrade our laptops during the COVID period. We probably upgraded our phones, upgraded our tablets. Somehow we also upgraded our vacuum cleaners, our hair dryers, buy a new Dyson hair curler. But when the economy reopens, I think the focus on upgrading those devices actually eases off a bit. And this is also has been trickling down to large ticket items like automotive. And for those who have bought their cars or upgraded their vehicles during the COVID period to enjoy all the SST exemption benefits and so on and so forth, would probably not upgrade their car in 2023 again with a short window of 1 to 2 years. So that's it. This is something that is not unique to the tech sector. This is a very big picture kind of element that is uncontrollable. It's something of a macro size. It's something to deal with why US is increasing interest rate, why our ringgit is depreciating, and why consumer sentiment on purchasing gadgets has been reduced. Okay, but that's it. We still have a lot of investment coming in. This is a summary of what the Penang state has actually brought in terms of foreign direct investment. So as you know, since the COVID, Malaysia has been recognized as playing quite a key role in terms of the global semiconductor supply chain. And we are benefiting from a lot of foreigners looking to invest in Penang simply because we have the ecosystem. If you visit Bayan Lepas industrial area, you can see a lot of names that you may recognize, be it local tech names or foreign tech names, TFAMD, Intel, Lam Research. Those guys have been committing their investments since 2020. 2021 was the peak, where that year actually saw 76.2 billion. And followed by 2022, when things eases off a bit, we still saw a 13.7 billion. And a total of these 3 years, actually, brought in 104 billion of manufacturing investment in Penang. And mind you that all this commitment does not translate into production the next month, the next quarter, or the next year. It probably will take 1 year or 1.5 to 2 years before this commitment or this building of plants turn into a commencement and production. Because it takes time to build, it takes time to qualify, make sure your machines are running at good yield rates before you can start producing at a mass production scale. And so I will just go through a few key names that is quite prominent to me and you. Firstly, Intel has announced their Pelican project, which is going to be their largest investment in Malaysia, and specifically it's going to be in Bayan Lepas. They have committed a investment of 7 billion USD, which is around 30 billion ringgit. And it's going to be a multi-phase expansion, which meaning it may spend across maybe 5 years or more, because you can't actually spend 30 B over just 1 year. So start in 2024, and this will be focusing on new chip packaging and testing factories in Malaysia. And they estimated that this would bring in 4,000 new workers. Okay. Next, we have Lam Research. In Intel, I think you and me know, is basically the processor on your laptop, on your PC. They are strong in the data center space, but they are not involved in the mobile space. So it's more PC and data center CPUs. Next, we have Lam Research. This name may have been heard quite a few times. I think our government also always like to promote this name because it was the first front-end semiconductor company that came into Malaysia. What I mean by front-end, recall if you join our previous sessions of tech discussion, you know that Penang is very much a back-end semiconductor ecosystem. We do chip packaging, chip testing, and chip assembly. Whereas front end, they do wafer fabrication, lithography, and then they will pass those wafers to Malaysia, where the guys like Inari, your Unisem, your MPI does the packaging. Okay, and we are very strong in packaging because we have been doing that for many decades. We are able to compete on a global level on the back end side of things. So why Lam Research as a front end company is coming to Malaysia? Because in Malaysia we have facilities like sheet metal fabrication, we have metal stamping, we have all those metal enclosure kind of services even in Batu Kawan and Penang. So Lam Research designs equipment for the front end use. So their equipment goes to the wafer fab like TSMC, SMIC, or even Samsung. And why they want to move to Malaysia is to have better cost structure, leverage on the sheet metal fabrication expertise or ecosystem we have in Penang, and to be able to ship out to their end customers, which if you realize is very much in the Asia region, because TSMC is Taiwanese, SMIC is Chinese, and Samsung is in Korea. So it just makes more sense for them rather than operating mainly in US. And they actually have operations in China, but why they are moving some to Penang is to, in a way, mitigate the trade the trade war that has been ongoing. So in order to not cause any hiccup in terms of supply chain, they want to make sure that their machine ships on time. So that's why they choose Malaysia, because Malaysia is pretty much I would say, in a way, is viewed globally as a neutral country amidst the US and China trade war. Malaysians are able to communicate proficiently in the English language and also in Mandarin if needed. And we have the ecosystem. And we are not restricted to any sanctions, either by China or the US, making Penang very much a favored location. So if you look, there are around 800,000 square feet, and they need another 600 workers, which has increased from an initial 350 workers. And recently, you can see that end of last year, they say they are committing to move more operations from China to its Penang facility. Next, we have Bosch. Bosch, on a consumer level, we may know it as manufacturer of power tools. You do your DIYs at home, you use their power drills, but what they do on the industrial segment is a bit more in-depth. They even go into automotive and also automotive sensors. And they are building in Batu Kawan, and they will have a facility of 1 million square feet. And this is an investment of 1.6 billion with the need for 400 new workers. Okay, this is Simtech. Simtech is more related to PCB production. PCB stands for printed circuit boards. They are expanding in Batu Kawan, and they have a land space of 18 acres, which is very large. They need around 400 workers for their latest phase of expansion, which is at 221 million. So they expanded the 500 million already, and now they are going to expand in another phase, which is worth 200 over million. And where does this PCB being utilized? It's for a high density interconnect where you have your standard PCB you see in your CPU. If you open your PC, that is a very typical CPU, but for industrial use, data center, you need a more specialized PCB where you can connect more than one processors. So currently, if you open your laptop, your PCB, the green color board only has one slot for one processor. But if say you're in a data center, you need to run a AI server, you need a data center chip CPU, and you need probably 10 chips on that specific PCB. You go to Simtech for this kind of customized interconnect PCB. So this is also happening in Penang, but it's on the mainland side in Batu Kawan. Micron is a name that is, I think all of us use it. We may not realize it, but your memory, your SSD, your memory in your smartphones, be it Apple or Android phones, have Micron device inside. It's basically the determinant of whether you have 128 GB in your phone or you have 256 GB in your phone, and Micron is the one producing this memory component. They're also building up their second factory in Bayan Lepas, increasing their floor space from 600,000 square feet to 1.5 million square feet, and it's currently under construction. So existingly, there are 4,000 employees in that 600,000 square feet facility, and to increase it by doubling to 1.5, you can just imagine how many more employees they were going to need in the future. So again, this is what they're doing is related to computer memory and also data storage. And if you notice, I put a potential beneficiary at the last, for a few of my previous slides also, is just a gauge on who or which local company may potentially benefit from their presence or their new presence in Malaysia. And as you know, we have been liking Kenangga Group as a company that helps to be part of building new wafer fabs and new front-end facility, because they supply a lot of high purity gases system that is used in these facilities. So you really need this kind of infrastructure, and Kenangga is one of the unique provider in Malaysia that does that. And Micron is one of their customers, so especially in Micron Singapore. Next, we have Infineon. Infineon is quite a staple name in the automotive space. They focus on automotive semiconductors. So if you happen to drive a German car, likely or not, you have a lot of Infineon components in your vehicle, in your Mercedes, in your BMWs. so on and so forth, and even down to local cars. So they are building their third site in Ulim. They announced it early 2022. It will be an 8 billion capital expansion. And they also in August 2023, which is a few months ago, announced another 25 billion investment in Kulim. And this would become their world biggest plant for focusing mainly on silicon carbide. So if you join us few sessions ago throughout the pandemic periods and up to today, you would get a hint of this term silicon carbide. Is basically, we have been using silicon for semiconductors for many, many decades, and we have squeezed out all that is possible of a traditional silicon to enhance our semiconductors. We basically have been so familiar with it that it has reached a peaking point where anything above it is not very much possible. So hence a lot of semiconductor players are exploring this new element by adding carbon, the element carbon into silicon gives you silicon carbide. And the end result of combining these two components results in, if you use it in the EV, which is very much used in EV now, especially in your Teslas and all your new EVs, silicon carbide offers better heat retention because you can withstand higher heat temperatures. You can charge it at a higher speed, at a higher voltage. And it has a characteristics of, because you don't heat up so much compared to common silicon, you will have lower power loss. So you charge X amount into your vehicle from a charging station, you probably get X minus, just example, 5%. But if you use normal silicon, you might get X minus maybe 15 or 20% because of the power loss resulted from too high temperatures. So silicon carbide mitigates it. So you get faster charging speeds, you get to charge at higher voltage, it doesn't heat up that fast, and it gives you longer driving range. So if you notice the earlier phases of the Tesla Model 3 that is not launched in Malaysia, but in the US, when they switch to silicon carbide, while the battery capacity remains the same, the driving range actually increased quite a lot more, and the charging speeds actually reduced more than 50%. So this is why a lot of semiconductor, especially automotive semiconductor guys, are going big on silicon carbide, as they think that it would be eventually be something a staple element to be used in the automotive space. And it's still something, it's not something new, it's been used commercially, but the production of it is still considered quite small relative to the potential size that say probably when EVs become the large percentage of total car sales. So this new plant that they talk about requires around 900 new hires, and you focus only on this thing called wide bandgap semiconductor, which is a term used to classify silicon carbide and gallium nitride. So gallium nitride is again a new component that they are exploring that actually is used for smaller devices like charging your laptop or charging your phone. So if you notice, if you buy more Android phones or you buy third-party chargers, you see that last time to charge maybe I can give you an example. Last time to charge a laptop, you require very big charger, especially a powerful laptop. But nowadays, if you look at chargers that transition from silicon to gallium nitride, if you can see here, this is a third-party charger by a company called Ugreen. I think it's a Chinese company. They managed to squeeze 100 watts of charging power within this brick. And because they are using gallium nitride to reduce the size of the components, withstand higher heat. So within that small size, they can squeeze in more components and to able to hit 100 watts kind of output. Traditionally, if you look at how laptops, the 100 watt battery charger would typically be quite a big, chunky, heavy brick. Because of gallium nitride, we can minimize it to the size of this. And at 100 watts, you can more than efficient to charge your phone, 2 phones and a laptop at a fast charging speed also. So this is how new components help to evolve traditional components like common silicon. Okay, and the potential beneficiary again, we put Kellington Group because Infineon throughout all their expansion has been engaging Kellington for their ultra high purity gas supply systems, and we don't see any other choice besides Kellington when they are going to expand this third site in Kulim. Okay, so now we go to a bit of a local scenario where we see a lot of expansion going on. We see that this commitment has been placed. Penang minister has been always announcing new FDIs coming into Penang. But why is our tech sector still on a sideways trend? Why aren't we benefiting from a huge demand and a huge rally, say, in interest in the tech companies? I think the first thing we need to take note is that, again, building these plants does not come overnight. You need the groundbreaking, you need surveying. After you build the plant, you need to bring in equipment, you need to go through qualification. Your customers, like Intel's, let's say Infineon's customers, have to probably come and qualify some of the plants to make sure it's intact. And Infineon itself after building here, they have to also in a way source some supplies from local companies like Malaysia, like MPI, and they have to do their own qualification whether those local companies can take on the volume that they are going to bring into Penang. So these things take time, and at this juncture, there is a need to balance in terms of capacity and order visibility. So if you look at the simple illustration on the right, this shows quite a clear example of what situation we are in now, where capacity outweighs the order visibility our local guys have in hand, or even foreign MNCs. So why this situation has happened? Because given that prior to the economy reopening, when we were in COVID, the scales are tipped differently, where order visibilities are so long, people are begging for capacity, want to lock in more capacity because they are afraid they cannot get components. Remember, we have automotive component shortage, we have smartphone component shortage, PCs were hard to buy, everyone are snatching for laptops because of work from home culture. But because of that increase in surge in demand has caused a lot of the supply chain to see that, okay, actually my capacity is tight. So based on what the supply I'm seeing, what the demand I'm seeing of that time, I need to expand, because if you follow companies closely, they're operating at 100% utilization rate. Some are running dual shifts. Some are even stating they're operating at 120%. So to run more than 100%, basically you do more shifts. You do more, a few batches of production to run beyond what your typical 100% can produce. And at that point, a lot of them see that they are reaching a bottleneck, that there's no other choice than to expand. So in order to not alleviate the bottlenecks, they are forced to expand. And that's why you see all those expansion being committed in the past few slides. Along with capacity expansion comes with, you need people to operate your new capacity, and workforce also has to increase. So it's a thing that has to move in tandem. And corporates, especially in Malaysia, at the time of COVID, we were restricted from hiring foreign laborers because of the closure of our borders. So when the economy reopens, there was a hiring spree. Everyone tried to grab as many workers as they can. And they want to secure a lot of quota because they scared they are not able to have enough workers for the expanded capacity. But later, do we know, or less that we expect, that demand actually eased off quicker than expected? And one contribution to that is that when the economy reopened, suddenly the shift from splurging to upgrade your devices has moved slightly to, say, traveling locally and traveling abroad. People want to splurge on different things rather than gadgets because I've upgraded my phone twice during pandemic. It's enough. I want to upgrade the third time. So those demand ease off a bit. And middle of last year, cost has increased. The government increased the minimum wage. So the minimum wage of all the workers, the expanded workforce that those companies hired, they have to pay higher. And also, beginning of this year, industrial companies have to pay higher electricity tariffs. So your electricity cost increased, wage increased, your capacity increased, your workforce increased, but your order visibility has shortened because the demand from end users actually reduced. So customers of these companies are actually telling them, we have to retune our forecast, revise our forecast that we have given you during the COVID time. We have to reduce it simply because we see there's a bit of a change in consumer behaviors. And during the COVID time, we were very focused on just in case inventory system, where people buy and lock in orders just in case because they are scared they are not able to secure. For example, at one point, companies are locking in 1 year ahead of capacity just in case because they don't want to be left out. But very quickly, a lot of them have reverted to just in time, where they say, okay, I think if I need it next month, then I'll give it to you maybe 2 weeks in ahead or 3 weeks in ahead. So the visibility of these companies actually shortened so much, from as long as 12 months down to, say, some is even shortened to a month. At best, some are seeing maybe 2 months on improvement. And this is something that they have to juggle with. It's a difficult balancing act because on one hand, you have new capacity. And mind you, when you have built new capacity, you have taken possession of that capacity, depreciation starts to kick in. It's like when you buy a house, you have a VP process, you get the keys, your installment would be the full amount of your loan already. So, and if you have no tenant coming in, you are paying a lot without. Similarly, for in the industrial sense, you're having to finance the building. You have to recognize depreciation for the building and the equipment, but there's no the revenue is not coming in as strong as what you anticipated. So this is the situation now. And again, consumer now think twice on purchases, especially for large ticket items. So with this balancing act going on for the last 12 months, the question that comes to mind is that, have we actually bottomed? And this is a question that we believe it should be taken with a grain of salt. The statement that the worst is over has been appeared on headlines for the past, I think, at least 12 to 1.5 years, saying that, oh, the worst is over, the worst is over. But after more than a year, we still see that this statement hasn't really materialized. So in short, our answer is selectively, yes. and later on only we'll discuss who actually has actually shown, or which company actually shown indicating or early signs that they have bottomed. So again, the statement or the view that we have that selectively some companies have bottomed is barring any black swan event. So of course we can't anticipate, say, black swan events like recession, a global recession, or say a further escalation in the ongoing wars. Note that you have your Ukraine-Russia war, and now you have your war happening in Israel and Gaza, and those are something that is beyond the control of, say, the tech sector. This is something that is on a macro level that tech companies have no control on. So, but putting those events aside, we like to think that most of the downside in the tech sector has been revealed. We said that in the sense that we see that the first thing that actually caused the big decline in the tech stock prices is the rapid increase in interest rates, or specifically the US interest rates. If you look at the chart on the right, you can see how during the COVID time, they reduced the interest rates dramatically close to zero. And when the economy reopens, they increase it in such a steep manner. And now they are around 5.5% from close to 0%. And that has put a lot of pressure to equities valuation, because why is that? Basically, in the US or generally in equities, people look at people generate the cash flow, discount the cash flows of companies to find their intrinsic value. So if you are discounting it, your denominator at a higher number, typically when you bring it backwards, your valuation or your intrinsic value that you generate is lower. So this is why it sent prices down when the early spike of the rates. But we have been through a lot of rate hike cycles already in the US. I think I also lost track how many times they've increased, but it's definitely a very steep one, up to 5.5. And I think consensus are also indicating that the rate hike cycle is approaching its peak, if it haven't already peaked. So with that said, why we say we also take that with a grain of salt, because when we say it's approaching its peak, many people would think that, oh, it means that the worst is over, there will be a V-shaped rebound in tech stocks. When the rate cycle peak means the Fed is going to drastically reduce interest rate in the short term, but we don't think that is going to happen, because while the Federal Reserve paused on their rate hike, over the long term, they are still maintaining a very hawkish kind of outlook, indicating that they are still looking, if necessary, they would take action if they deem necessary. So this means that the interest rates could remain quite elevated. Inflation has been rather elevated also, despite interest rates up. Then consumer spending may not be as strong as when rates were close to 0%. And this means at the end, it translates back, trickle down to, will you upgrade your phone now again after a short period of time? If you and me, the answers are still, I'll think about it, I'm not so sure, I think I'll hold it for another 2-3 years, then you probably know what is the outlook of the companies that are making these components. So that's why we say that the worst is over should not be a blanket statement for the entire sector. There may be selective companies that show that kind of inversion kind of signal, but we are still caution on what you and me actually translate that. So we still caution to manage expectation, as we don't think that is going to be a strong V-shaped rebound in sight, especially in the short term. as of now. And which company that we are selective in is one is Inari, because in the latest earnings result, they have reported actually sequential quarter-on-quarter growth, and their margins has recovered to a more than 20%, a strong 20%, more than 20%. And this is back to their normal margins. And mind you, recovering margins for tech sector is not as easy because, again, we mentioned electricity cost has gone up, and it's quite significant for some companies. The electricity cost per month has increased more than 50% since early this year. And as you know, semiconductor, you have to run many equipment uninterrupted. So you have to use a lot of electricity, and all these plants have their own dedicated substations in their premises because of the intensity of electricity that they are consuming. So with the increase in tariff, that impacts them a lot. And there's another cost increase, which is labor costs. So to recover margins is something that is very commendable, and we have seen that in Inari's latest quarterly results, indicating that they have recovered quicker than their peers in the local space. And on top of that, we follow them quite often. We heard from the group that they are having better order visibility from their key customers. And as you know, Inari's bread and butter business is radio frequency assembly and test for US smartphone devices. And while the numbers of smartphones indicated by the US producer maintain status quo year on year, but Inari is always looking to benefit from increased content per devices. So as you know, as we evolve from 3G to 4G, 4G to 5G, and eventually a higher end of 5G, which is a millimeter wave, or some people call it 5.5G. We do not dismiss off previous generation connectivity instantly. So if we upgrade to 5G in this new device, doesn't mean it will stop supporting 3G, because you have to still support 3G because certain locations are not covered by 5G. Hence, there's going to constantly be a growing content per each devices. And the content we are talking about here is radio frequency filters. And these filters are mainly used to block off noises. So when you receive a 5G signal, 5G is transmitted on a higher frequency. And typically when you transmit 5G data on higher frequency bands, there tends to be more noise. So why do you need filters? Is to filter out unwanted noise, because if you don't have a good filter to block off unwanted noise, your phone would consume a lot of battery just to search and try to stabilize that 5G connectivity. And hence you see why in the early days of 5G phones, their battery efficiency is not good, because of the filters that are not up to par yet. But now filters are improving. We call it RF filters. And now they are able to block off a good amount of noises to maintain a strong signal to noise ratio. And as you evolve down to support 5.5G and say eventually 6G, you are basically moving up higher frequency bands. And that means you need to keep evolving your filters to take on higher challenges in terms of filtering out noises. And that's why Inari estimates that they are looking at a 5 to 8% kind of increase in content per devices for the latest smartphone. So in spite of total volume of that smartphone may be maintained, say the specific brand, but the content per smartphone increases, this also translates into better growth for Inari, because they are selling more content. And because of that, their utilization rate has improved to 85% from a low 65% in the prior quarter. And Inari has stood up among its peers as a company that they really know how to, again, balance between order visibility and capacity. So among Malaysian companies, we see them as one of the better, well-managed, where a lot of their capacity are well utilized. Even the older side of capacity where it's using legacy machines, they have their in-house engineers to tweak these machines, modify these machines, and use it for leading edge purposes or leading edge product. So by doing that means your old machines is already depreciated. Say it's fully depreciated, there's no more depreciation on that machine, but you are able to modify it to service new products. This means that the revenue generated from that machine is going to increase significantly in margins. Hence, you see why their margins are being able to recover quicker than their peers in spite of higher electricity costs and also higher labor costs. And this is something that is very much unique to Inari. And what is their big vision for Inari is that if you follow them closely, you can see that they are building a very big capacity in China, Kunshan. And why they are doing that is they understand that Malaysia is unique, that we benefit both from the US-China trade war. However, going forward, although now we are not under sanctions or anything, but to avoid any possibility of such, Inari is taking a proactive approach to only service the West with their Penang facility. And they are expanding in Kunshan, China to service the domestic China customers because, again, our back-end semiconductor ecosystem is strong. We are competitive on a global scale, and being able to offer that kind of expertise in China is going to be highly sought after. Hence, Inari is focusing on their strategy called China for China, and my Penang plant is going to be for the West. So there's going to eliminate any possibility of conflict where you have China and Western companies being produced in the same facility. So they're looking to capture both sides of things. So in a Chinese saying, this would be like a 鹬蚌相争，渔翁得利, this kind of situation. Next, we are also maintaining our optimism on Kellington Group or KGB, simply because they are able to offer that visibility, which is very much lack of in the past 12 or 24 months. So if you look at the first chart I showed you at the beginning of this session, the tech stocks plunged 12 months, sideways 12 months. So for the past 24 months, Kellington is still able to offer that visibility while a lot of other tech or tech-related players actually aren't able to. And this is because Kellington has been able to lock in order book of 1.7 or close to 1.8 billion. And these order books are for who? Again, it's for all the MNC's expansion that I talked about earlier, the FDIs into Penang, the investment of Infineon or Micron in Singapore, and the expansion of SMIC in China. So again, this expansion don't come overnight. It's going to take 1 to 2 years to build. And that's why Kellington, throughout the past few years before the tech sector came to a pause or came to a plunge, they have actually secured those order books, and those order books are non-cancelable. Okay, so they have this order book to actually weather them throughout the down cycle of this tech space. And again, Kellington is, I would say, in a way, they serve as a leading indicator to the tech space because they are their orders comes way ahead before the companies or the facilities goes into mass production. So by looking at Kellington or monitoring Kellington gives you a good sense on how is the expansion of MNCs in Malaysia, in Singapore, and in China. And from that, we can see that there's still a good indication of tender book that at 2.3 billion, that is spread evenly across, again, Malaysia, Singapore, and China, because these three locations are where Kellington have their strong presence in. So, example, in Singapore, throughout all the expansions of Micron, Kellington is the one that was their partner in the gas systems. Similarly, in China, they have customers like SMIC, which is one of the biggest wafer fab in China. And Malaysia, those of you who are familiar with, they are the one that builds the facility for Siltera, is a wafer fab in Malaysia. Although that wafer fab is not as competitive in terms of leading edge processes as other big names, but they still have their niche in the higher process or the more matured process nodes. And in Malaysia, they do a lot of gas systems for Infineon and also for Osram in the North Kulim. So we see them as a proxy to front-end wafer fab expansion, and we like them simply because we know they're able to deliver on their earnings. And I think based on what they have been delivering, if you look at their earnings delivery and their order book, you can easily sleep well knowing that they're going to deliver another record year this year. And 1.77B is as of the beginning of third quarter. So you can expect a good chunk after delivering a record year in 2023, a good chunk of order book will keep them very busy even in 2024. And mind you, they are building their second liquid CO2 plant. And this liquid CO2 plant are used in industrial purposes, and the gases is of way higher margins than what they do for even Micron. So for gases, they are even able to recognize up to 30% gross profit margins, and which is a doubling effect of what they do for the likes of wafer fabs in terms of just the gas delivery system. So gases has higher margins, and that is something that they are looking to enhance on and build upon with their second plant, because their current CO2 plant is actually running at 100% for many quarters already, being exported to a lot of neighboring countries. So another two companies that we are selectively positive on, the third one will be PIE. As you know, PIE is unique in the EMS space because they are indirectly a subsidiary of Foxconn International, or Hon Hai, as it's known in Taiwan. So Foxconn or Hon Hai is one of the well-known names for assembling your iPhone, or most of your iPhones has come from Hon Hai, China, but the company is a Taiwanese company, and they indirectly own around 13% of PIE Malaysia. So that's why you see PIE has been able to, throughout the pandemic, when Foxconn's customer were looking to do some diversion of their production out from China, PIE was the candidate that benefited for those orders that moved out of China, because Foxconn recommended their customer to go to PIE, because one, PIE is their subsidiary, indirect subsidiary. Secondly, because PIE is in Penang. And again, Penang is a unique space that is free from sanctions and able to have the ecosystem to support. That's why their revenue PIE's revenue actually saw a big bump from 600 million per year. They were, after that, benefiting from Foxconn. They are doing more than 1 billion a year now in terms of revenue per year. And of course, they are not shielded from the slowdown. They also saw some slowdown, but from our recent visit to PIE last week, we see that they are indicating some recovery from the October onwards. Few of their customers are also putting in more orders. So we see that going to be contributing to quite a significant improvement in their fourth quarter, because from October onwards, after a stable third quarter. And beyond that, they have also onboarded 4 new customers. And these are customers related to medical, industrial sensors, and also industrial drones. And these 4 customers has been locked down, secured, and they are now ongoing a pilot production run currently. So again, all these things needs qualification, and they expect to hit mass production stage in 2024 onwards gradually. Because after doing your pilot run, you start from small volume production, and if your yield rates are met accordingly to customers' specification, you move on to your high volume production and eventually your mass production. So we expect 2024 to be a good year for PIE also, premised on their recovery of existing customers and also the onboarding of 4 new customers. And they have been gaining more traction in terms of customers' inquiries because the big step forward for them is when they took on that customer from Foxconn. So that serves as a very good track record in their CV or their resume per se. And if you are able to do accordingly to Foxconn's level and Foxconn is satisfied, Foxconn's customers is satisfied, that helped to bring in a lot more customers inquiries from there onwards. That's why you see their engagement with customers are very active compared to other names in the EMS space, which you might be more familiar of, which I wouldn't want to name them, but I believe if you look at traditional EMS, you'll be familiar with those couple of names who are more focused in household products. Whereas PIE is a lot more balanced in terms of industrial, data centers, or data computing, and also consumer. So that helps them to shine above other EMS company that is solely dependent on consumer household electronics, because when consumer pulls back their spending, those companies actually suffered quite badly. Whereas PIE, who have a more balanced portfolio, are able to weather through those turbulent in a better shape comparatively. And the last company that we are selectively positive on is LGMS. So LGMS is operating in a space that is relatively new in Malaysia. I think there's no substitute or no competitor that is doing exactly similar to what they are doing. There may be a lot of companies or IT companies or who call themselves IT companies in Malaysia or in the recent IPO this year, but we believe none of them are as unique as LGMS in the sense that LGMS is a cybersecurity service provider. So a lot of people mistaken them for selling antivirus software. That's not what they are doing. That is what those other IT companies are doing. And those other IT companies who sell software, sell hardware to you, be it CloudPoint, be it Infoline Tech, or be it Infomina, those are undoubtedly IT companies, but they are not providing you with their proprietary software or system. They are reselling software, they are reselling hardware. So we call them system integrators. They buy products, they buy softwares from the software developer or a wholesale distributor like VS Tech, who is listed also. So if you walk in to Plaza Laoyat in KL, most of the stores get their hardware products, their graphic cards, their CPUs, their tablets, their iPhone from VS Tech. VS Tech is a huge supplier. Almost 90% of Laoyat stores gets their product from VS Tech. And similarly, how does Infoline, Infotech, or say Infomina operates differently is they get the products. VS Tech just sells and distribute. This guy buys it, resell it to corporates, like they sell it to could be a bank, they sell it to a SME, but they also provide integration services. So they help, they will just bring the products to your premise to set up for you, configure for you, In a way, they also help you to maintain that device, that firewalls that they installed for you. So typically their margins are slightly better than VS Tech because VS Tech is purely distribution. And Infoline, Infotech, Infomina, they are resellers, but do some integration and maintenance for you. But they are not offering you something that is unique to them. They are still a system integrator or SI or a reseller plus value-added services. Whereas LGMS is different. So I think a good example is in a medical field, you would think of the manufacturer of the medicines does not sell medicine to you. They sell medicine to pharmacies and pharmacies sell it to you. So pharmacies or doctors would give you a prescription and ask you to buy from pharmacy. That's how maybe Western medical situation works. So Infoline, Infotech, Infomina, they are pharmacies. LGMS, they are doctors. They give prescriptions. And Infoline, Infotech, they based on your description or prescription, they would recommend you medicines because they sell a lot of different kind of medicines. So LGMS do penetration testing. That's one of their main services. And basically, you can think of them as ethical hacker. The word hacker may be a bit strong, but we call this in the cybersecurity world as white hacker or ethical hacker. Basically, they would penetrate, you would hire them to penetrate your system to find loopholes in your cybersecurity space, and then they will recommend you what to do with those loopholes. They do not sell products, they do not sell software. They will just tell you what is the diagnostic, what's the diagnosis, where is the problem, and they can give you recommendation, and the company or the banks can go and source from those Infoline, Infotech on the end solution, whether it's a device or software. That's why you see LGMS margins are quite high because their main cost of their revenue generation is human power or software engineers who are actually proficient in software coding. So, and penetration to this industry is not easy because to be qualified globally or recognized globally as a qualified vendor to actually do this penetration testing, you need to go through a lot of qualification on a global standards. And this is why Japanese company Mitsui, which is the company that builds the Mitsui outlet in Sepang in Malaysia, but Mitsui goes beyond retail outlets. They are a huge conglomerates that even owns IHH in Malaysia. They are a conglomerate that spans beyond different products from be it from cybersecurity to retail outlets to a lot of industries. They also invested 25% stake in LGMS because they want to tap into LGMS expertise and bring some of their cybersecurity know-how into the Japanese market. And on the other hand, LGMS, by accepting Mitsui as what you call a strategic investor, they are able to tap onto Mitsui's network. And again, because Mitsui's are investing in so many different companies across the world in different industries, and eventually cybersecurity is going to be something that is a necessity rather than an option, because as we evolve into AI, as we evolve into a lot of this more high-end connectivity, more online transactions, and so far and so forth, cybersecurity is going to be something that is of very key importance, be it on customer ends, on the provider end of things, and even on the ESG front. You can't have a bank that is lacking on cybersecurity, and on the ESG front, cybersecurity is also becoming a strong ESG factor to evaluate whether they take data privacy, data protection act seriously. So we think this is a structural thing. It's going to be a long-term thing, but it's an eventuality that will materialize. And that's why we think Mitsui is smart enough to go in and have that strategic stake of 25% in LGMS. And mind you, Mitsui does not simply invest in a small company like LGMS without very thorough due diligence and research. So that's why we think in the long run, with cybersecurity gaining awareness, LGMS is a company that is unique in that space. Like if you want exposure to that side of technology. Okay, so that is our 4 selective picks. Again, we highlight the word selective because we think that the worst is over for selective companies, but we are still a bit hesitant to throw a blanket statement that the worst is over for the entire sector. Okay, so that's the semiconductor side of things. Those are the back-end semiconductor that we are familiar on, a bit of innovation from cybersecurity. And recently, we are entering a new phase, which is AI. So AI has been something we are not unfamiliar of in terms of the term, but it is gaining a lot of awareness with the start of ChatGPT. So with some of you, you might be using ChatGPT already. Some of you who have not been using, I think it's good to try out to see what is the progress or what is the possibility of AI at this juncture and where could it show us in terms of future. So we see a lot of headlines surrounding it, and the US trade war is, I would say, is showing no signs of easing off. Right? It's just going to keep intensifying, with US trying to suffocate China in terms of their access to software design tools, front-end fabrication tools, and even end products that is used in AI. So the latest ban on China is coming after China launched their Huawei Mate 60. So technically, if you recall what is semiconductor manufacturing on the front end side of things, we talk about things like 14 nanometer, 7 nanometer, 5 nanometer. Basically, we are shrinking down the transistors on the chip in order to squeeze more transistors in the same chip size. And this will bring about better efficiency, better processing power. But US is scared that China has too much access and may overtake them in terms of development of computer chips or even smartphone chips. So they ban a lot of equipment from going into China. And to design those chips, you need software, which is a lot are coming from US. You may heard it's called electronic design tools from Cadence and Synopsys. These are the 2 big companies in US that supply this software. Again, they are banned from selling to selective Chinese companies. And basically, US don't want China to be able to produce the chip based on 7 nanometer. So prior to that, China is always stuck at 14 nanometer because of the limitation of their existing machine. To go into 7 nanometer, you need a machine called EUV for lithography, which is an extreme ultraviolet EUV machine. But what they are having now is a DUV machine, which is in a way, by its original design, not capable of doing 7 nanometer. But how the Chinese do it is because they are squeezed into a corner. They have no other options. They do a lot of their self-modification on their older machines. That is not to the manufacturer's recommendation. They do a lot of DIY, and they are able to produce 7 nanometer. But this production is without the efficiency of, say, the likes of TSMC or Samsung that is using the appropriate EUV machine. But we believe what China is trying to do is to make statement. They want to make a statement to show that to US that despite you strangling off from all this access to equipment, through our modification, we can still produce 7 nanometer chips. And we are going to launch it in our new Huawei Mate 60. But from our channel checks, this production is not as efficient as the Taiwanese or the Korean producers. But again, because of this statement, US, again, they are frightened. They say we must push ahead our Chip Acts. We must make sure our US companies no longer give business to China. We must make sure they pull out from China to produce, because if they don't pull out from China, they won't get the grant from our Chip Act campaign. So a lot of restrictions have moved out. Recently, the US also restrict the export of NVIDIA chip to China. So NVIDIA's chip, if you guys are mining cryptocurrency, you'll be, or even you're playing high intensity gaming, which requires high-end graphics, you know that NVIDIA chip is one of the better processing unit because of their ability to do intensive calculations. And intensive calculations is an important aspect of not just gaming, but also in AI, because in AI, you need a lot of calculations of possibilities, say, in an electric car, or even to calculate the response of ChatGPT to your questions. You need a lot of instantaneous calculations and permutations, which requires NVIDIA chips. And US is limiting those exports to China. I think this news is in October 17. They are also banning the tailor-made chips in to ship to China. That's why there's a lot of need to move out. And why I highlight the word tailor-made, I would elaborate more in the further slides. So this is the situation of the AI from a semiconductor point of view. And what's happening in the AI space is that the play of Moore's law is still very much viewed upon as a guidance, no longer as a something that is cast in stone, but more of a guidance, because what Moore's law say is that the transistors per microchip doubles every 2 years. So that's why there's a need to move from a higher process node to a lower process node. So to give you an example, because iPhones is something that common that we use daily, if you come from an A10 Bionic chip to an A12 Bionic chip, which is a 2 years gap apart, the transistors indeed doubled from 3.3 billion transistors on the same size of silicon to 6.9 billion transistors. So there's a doubling effect, or 2.1 times effect, which is in line with Moore's law. But as you keep doubling from, say, 1970s up to the year 2020s, the incremental number of transistors may no longer be a doubling effect, because as you shrink down the size, say from the A14 chip, 5 nanometer, to the A16 chip, which is again a 2 years gap, and the A16 chip is in the latest smartphone of the iPhone 15, especially the Pro model. You see the transistor count increase is only from 11.8 to 16 billion transistors, which is a 1.36 time increase instead of 2 times. So we can see Moore's law has been guiding us for the past many decades, but we are approaching a level where nanometer reduction in the nanometer no longer helps us to double transistors. And why there's a need to increase transistors? Because again, for the same size, you have more transistors, means in the same workspace, you have more workers working for you. And transistors are power generators, so they can process more information. That's why you see Apple always advertise our new A16 chips can do how many calculations per minute or per second. And because those transistors are smaller, they emit less heat, and therefore you get better energy efficiency despite having higher processing power. So this is key reasons on why the semiconductor industry is having a constant race to miniaturization of the process node. And this brings us to AI, or even IC design, because the space that Malaysia always operates in IC design, back-end semiconductor. We only do packaging. Let me just jump to this slide to show you. The front end of semiconductor is always done by the big guys, okay? Up to the process of step 9. It's all done by your Samsung, TSMCs. It's done. The designs are done by your Broadcoms, your Qualcomms, and they pass those designs to your SMIC, TSMC, and TSMC do most of the step from step 1 to step 9 and step 10. And only at step 11 and 12, only it's passed to Malaysian players like Inari, MPI, or Unisem. And if you look at it from a value chain perspective, those are called packaging and testing, which is of a lower value or even lower margins if you compare it with the front end guys. That's why you see TSMC can make gross profit margin of 50%, whereas down to packaging guys, your likes of MPI, Unisem are doing net profit margins on good times at teens, maybe 10% or slightly low teens. And if you flow down to EMS, which is your SKP, VS, PIE, the net margins further compresses to say, if you're able to do 4 to 6%, yeah, quite good. And some EMS are able to do inching towards high single digit of 8 to 9%, which is in a way quite tremendous for that space that they operate in. So hence what we are trying to say is that a lot of margins and money are to be made in the front end side of semiconductor. And where does that leave us in Malaysia? Can we actually do it? Because for past many decades, we only operate on the lower end side of things. But with US-China escalation going, intensifying, China cannot get the chips they want. China cannot design the chips they want. China is finding it hard to fabricate the chips they want to be in the AI race. So they aim to still push for technologically self-sufficient state. And that's why the likes of Alibaba, Tencent, even ByteDance, we call them hyperscalers, they are looking to differentiate by having their own AI chip for their own specific usage. So we call this an age where you will see there's more demand for application-specific integrated circuit, and it's expected to increase going forward because without access to NVIDIA, and going forward, we believe NVIDIA are products that are off the shelf. Going forward, a lot of people want AI to be customized, designed for their own internal usage based on their own specification. Hence, they are looking outside of China on who can actually have access to design software, who can have access to design facilities on the front end, who can have access to design, who have access to the back end packaging facilities to help them design all this customized chip that is not available or off the shelf. And this opens up opportunity to Malaysia that is free from restriction. And in a way, Malaysia is still a neutral country in the trade war situation. So can Malaysians do it? AI design, IC design, and wafer fabs has been mentioned in the latest NIMP or New Industrial Master Plan that our government has actually launched it I think just a month or two back. So by 2030, they hope that Malaysia can be on a global level in terms of IC design, EV, renewable energy, and AI. They want Malaysia to be able to advance to a level that you can attract more wafer fabrication companies to do their fabrication in Malaysia. But currently, where are these wafer fabs going? So wafer fabs are still being built in Singapore. That's the closest we can see to Malaysia, because Singapore is still a country that is more secure in terms of political stability, and also government is actually supportive of high-level tech production. And again, wafer production involves a lot of intellectual properties, where Malaysia is still very much not up to par compared to Singapore in terms of protecting intellectual properties. And Malaysia also looks to groom game-changing advanced material. That's what we talk about in silicon carbide, gallium nitride, and basically establish Malaysia as a generative AI hub. As a Malaysian, we can't fault ourselves for having doubts after hearing all these big jargons of IC design, AI, wafer fabs, but it's being pushed a lot by our government. So can Malaysia actually do something, because all the while we are in the back end? And when I say back end, we talk about packaging such as this, where if you happen to open up your new iPhone, you can see all those black parts. That is one of the final process of chip manufacturing already. All the high level ones are done by the Western guys. But we believe that although this would take some time, there's companies in Malaysia that are still small but are trying to take the first step forward to do this, because chip design is totally a different game. To design this chip from a ground out, it probably takes you at least 1.5 to 2 years, or 2.5 years to actually bring it to a actual product. And before that, you have to go through a lot of testing before it becomes a mass-produced chip. And this involves different expertise rather than mechanical engineer. It involves a lot of electronic engineers to do IC designs. And say a typical design of one chip could take up to 200 engineers just to design one chip. So which companies that actually took the step forward to do this is OpStar. OpStar, if you know, it's listed this year in March, I think, and they are the first listed company to be first of its kind to move up the semiconductor value chain. And in Bursa, Malaysia, so far there's no other companies other than OpStar that is doing IC design. And why they are benefiting again is because China can't do it themselves, or find it hard because of all the restriction they have. They are looking for Malaysian companies that can actually offer them that solution. I mean, if you think about it, without this US-China trade war, China really don't need Malaysia to do this. They have more engineers than Malaysia. They have more human brain power than the size of Malaysian population. But it's again probably one in a lifetime kind of situation where Malaysia can actually stand out because of this trade war conflict and become a beneficiary of this high value production in the semiconductor value chain. And when I say high value, is because if you look at OpStar's gross profit margin is around 55%, and when it flows to bottom line is around 30% net profit margin. And before you start doubting, can Malaysians actually do it? You must know that the top 3 management, the COO, the CEO, and the CTO are ex-Intel employees. So they are from Altera. If you know, Altera are strong in ASIC, ASIC, and also FPGA. And these are the components that are going to be high in demand eventually as AI starts to become highly adopted by all these hyperscalers. And the CEO himself has more than 34 years of experience in IC design. All these guys have spent a decade or even 2 decades in Intel overseeing designs of IC chips, and they have gained enough knowledge to actually come out and open their own. So we are paying very close attention to companies like this because of its uniqueness and its ability to bring up the whole Malaysia tech industry to move up the value chain that we actually could not imagine. If you tell me 5 years ago that Malaysia can do IC design, I probably would shunt it off as quite an impossible idea. But here today, we have our first listed company in that space. And we look to monitor them closely, and we are quite excited that they are taking the first move to spearhead the direction for more Malaysian companies to follow suit. So that's all for my sharing today. I hope you have learned a thing or two on where our current traditional semiconductor is, and on the AI side, where can we have that opportunity to attract our not just talent and expertise and benefit from this AI adoption. So I pass the time back to Sean.
Thank you so much, Samuel, for doing this very detailed presentation on this technology sector. I guess many of us here have gained good insights into this sector, whether it has bottom and what is the forward-looking trend from this semiconductor space. So I think we have overrun for 10 minutes. So Samuel, maybe we just do one question on Q&A. Is that okay?
It's all right. I mean, if you want to take a couple, it's fine also
A
for
couple
me.
more is fine with you, right? Okay.
Yeah.
I think
Sorry for
let's
overrunning.
yeah, let's do three lah. Let's do three.
We
Okay.
can do a couple
Uh,
actually.
I think Samuel, you are very uh I think Kenanga is very big in terms of talking about the front end players in semiconductor industry. I think in Malaysia there are two companies that are involved that are listed. They are respectively Upstar and also DNEX. So what's your view on DNEX? Will they benefit from this AI chip? And then what are your house call on these two stocks? Do you cover these two stocks?
Upstar, we are, I mean, for AI, we are much more leaning towards Upstar being a first layer beneficiary because they are directly involved in the production of IC designs. And this is something that is highly sought after from the Chinese market now. For DNEX, we do not cover, and DNEX is a bit of a tricky company because DNEX as a company itself is an oil and gas company, but it acquired Siltera as a wafer fabrication company. So the earnings delivery from DNEX may not fully reflect semiconductor. It may be pulled down or dragged down or maybe overemphasized by the oil and gas segment they're involved in. So we do not like it as much compared to a pure play IC design company. And for the general public's knowledge, IC design for AIs or even fabrication for AI chips are in the high-end leading edge process nodes. You are talking about beyond smaller than 7 nanometer, maybe down to 4 nanometer, because you need a lot of processing power, whereas Siltera is still working on, say, 90 nanometer. Not to say that they're very far off in terms of technology, but not to say that their technology is no longer in use. A lot of things in our general usage do not need 4 nanometer processors. We are not needing that high end, say, for your TV box, for your day-to-day bigger items like your mouse, your chargers. Those requires more matured and higher process nodes. You don't need an AI chip to control your mouse. So unfortunately, we believe that Siltera may not be involved in AI processing chips.
Okay, understand. So what is your house call on the Upstar? Is there any TP given?
For Upstar, we are we initiated with a buy call. It did very well. So we are currently, after it had hit our TP, we maintain a hold call. Unfortunately, I think due to the weakness, not to Upstar, but the general tech sector, it has came below our TP. I think our TP is still at 180. So I think there is a good chance of us relooking at a possibility of increasing our positivity on Upstart again from our current neutral core. And if you look at the chart, it has been bottoming already. So I guess those that are looking to have a exposure to IC design can actually look at Upstart.
All right. Thank you so much, Samuel. The next question is by Ang. How much DIY can Huawei do as there are limitation to the DUV machine? Going forward with more restriction from the United States, will Huawei be able to innovate further? What is your view?
Yeah, thanks, Ang, for that technical questions. Yeah, it seems that you are quite well versed with the equipment side of things also and the limitation. You are correct. The yield rates of using a DUV machine to do something that requires a higher end machine is definitely not efficient. With increasing restriction, I think for them to go beyond even 7 nanometer itself is not produced at the at a highly efficient or commerciable, financially commerciable level. But again, I said why they are doing it is as a statement to the US. So I believe there needs a lot of more modification and hard work for them to go beyond that, which I think it is going to be a struggle. But if they can perfect 7 nanometer, I think it's something of a breakthrough. If they can perfect 7 nanometer at a efficient level. So currently it's slightly still inefficient. Just making it more efficient actually gives them a lot of room to play with, because 7 nanometer is still very relevant in our today's market. And is the next step beyond 7 is basically 5 already. So 7 is still very much important and relevant. But going forward to optimizing it beyond 7 is yet to be seen.
Understand. There are a lot of attendees today who ask your view about other technology companies. Maybe you just give a brief overview of all these companies, right? Or just mention a few. What is your view on D&O?
Okay, for D&O, we currently have a sell call simply because if you just open your app or your trading app, you can see their earnings delivery has been quite weak in the first 2 quarters. We expect the third quarter to see some rebound. Again, a recovery in third quarter or even a sharp recovery in third quarter, again, you must see it from a big picture kind of perspective. If they say they do 100% quarter-on-quarter improvement, that is just from 1 million to 2 million, while they used to do like 20 to 30 million a quarter. So coming from a low base, the percentage increase in third quarter is going to be wonderful or even mind-blowing. But on the big picture, one must still take that percentage increase with a grain of salt and see how the full year they are doing. But definitely in the second half, third, fourth quarter, there's going to be improvement. However, at this juncture, meeting that kind of improvement would just be in line with our expectation. It's not something that would exceed our expectation. Hence, we are still having a cautious view on D&O.
All right. So what is your view on Me Technovation?
Me Technovation is all more focused on ATE, equipment making. We believe that equipment delivery now is not going to be superb. I mean, those who follow Vitrox would know, because Vitrox is typically the bellwether in Malaysian equipment making for the semiconductor. And we believe the first layer of beneficiary of a tech recovery is the packaging guys, because even the packaging guys, your OSAT, your Inari, your MPI, your Unisem, they are not operating at their peak utilization rate. So if you are not operating at your normal level, why do you still want to buy equipment from the likes of MI or whatnot? So my existing capacity needs to recover back to my optimal level. Say I was operating at 50%, I need to increase it to 80% or 85% or even touch 90%. Then only I will start to buy new equipment. Hence, I believe equipment maker would be the level 2 beneficiary, or the second beneficiary after OSAT gets their utilization up and fill up their existing capacity.
All right. So what is Kenanga's views on Genetech?
Genetech. We don't cover Genetech per se, but we don't have a very strong view on it because we don't follow it that closely. They are doing more on EV batteries and likely to benefit from the EV adoption, or maybe Tesla itself. So I guess on that front, they are running on order book kind of basis, because their lines are EV battery packaging lines, which takes maybe 6 to 12 months to build up. So if they have sufficient order book, that should keep them running. But on the EV side of things, I think on one hand, in the headlines, you can see that EV is launching in Malaysia. Tesla is launching their new showroom in Pavilion Damansara. everyone is hyped out about EV, government giving incentive on EV. But if you look at the US, the interest in EV has declined over comparatively the past 2 years. And that is simply because I guess the hype is not as strong already. There's much more competition in the bracket of EVs that Tesla used to dominate, and Tesla has been throwing prices in the US and China, and more choices are out there. The infrastructure network is not catching up to the huge increase in availabilities and varieties of EVs. That's why I think I was reading up on EVs. The turnover rate or the turnover days for EVs has increased from 90 to 100 days to turn over one EV car. So that means it sits in a showroom for 90 to 100 days, whereas your petrol cars is still maintaining a good turnover rate of maybe 40 to 50 days. So EVs turnover rate has reduced a bit because of the increase in a lot of say Chinese EVs, Tesla throwing prices, so on and so forth, and the still lack of the infrastructure. Because back then, those who are going for EVs are those who are able to afford EV as their second car or their third car. Their primary car is still the petrol car. Whereas with more lower prices EV, they are basically targeting the maybe the guy that would probably use the vehicle at a price range that would afford a daily car. But as a man or lady who wants a person who wants a daily car, I'm still having that range anxiety of whether can I charge it if I go 300 kilometers to this destination. So hence, again, the turnover rate has lowered.
All right. So am I right to say that you feel that the EV team stocks are overrated?
I would say it has enjoyed a good run, and there needs to be, I mean, the range anxiety has to be something that people can be acceptable. Then only we can see another kind of catalyst lah. So in a way, I would say the EV team has very much been known. Everybody knows the upside. It is going through a bit of stabilization or a bit of correction. So there's nothing that can surprise it for another rally in the short term. That's what I would say.
All right. Thank you so much, Samuel, for sharing your perspective in this issue. All right. So with that, I think we have come to the end of this Q&A session. So apologies if we overran the session for a little bit, and hope that you have enjoyed the session so far. So ladies and gentlemen, you just heard from the head of technology and tactical strategy of Kenanga Research, Mr. Samuel Tan.
Okay, thank you so much, Sean, for this session, and thanks a lot to all the participants that joined in this evening. Have a good evening or good night. Hope you learned a thing or two. Happy to see you again on our next tech session.
Yes, thank you so much, Samuel. And for those of you who haven't had a Kenanga Share Trading account, you may fill out this online account opening form that I've given you in the chat box. So if you click the link, it will take you to a site where you can fill up your interests and you can actually open your trading account online. So if you haven't joined Kenanga Trade to Win Telegram channel, here is also a link for you to join Trade to Win Telegram channel to get trading ideas of what to buy and what to sell. So if you haven't downloaded the latest Kentrade 2.0 mobile trading app, you may go to the App Store or Google Play, download Kentrade 2.0, which is a revamped app for you to trade better in the stock market. All right. So with that, I want to thank all of you for staying tuned until the end of this webinar. Hope that you have gained enormous insights into this technology sector and make informed investment decisions in the technology sector. With that, thank you everybody, and hope to see you in our next Kentrade webinar. Bye-bye.